Today, the debt machine is alive and well. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. As we approach the end of the year, we got some stats from the RBA on credit to the end of November. Whilst the debt is growing, the value of housing assets is falling, and this is a nasty pincer movement. And by the way, if you value the content we produce, please do consider supporting our efforts. You can make a one-off donation via PayPal or consider joining our Patreon program. We really appreciate those who are contributing to help us continue to make great content. The links are in the comments below. The RBA's credit aggregates reveal that in seasonally adjusted terms, total credit rose by 0.34% or $9.9 billion to a new record of $2.9 trillion. Within that, credit for owner-occupied housing rose 0.38% or $4.63 billion to a new record $1.21 trillion. Lending for property investment was flat, standing at $0.59 trillion, and lending for business rose 0.56% or $5.32 billion to $0.95 trillion, another record. The proportion of business lending to all lending rose to 32.8%, while the share of residential property lending for investment property fell to 32.9%, the lowest in years, but still too high in my book. Credit growth is still too fast. The trend charts show that on a 12-month basis, investment lending has now only grown 1.1%, while owner-occupied lending is still running at 6.8%, still faster than business lending. And personal credit continues to fall. This indicates that despite all the hype about tight lending, loans are indeed still being written at a growth rate which is well above inflation and income. And as a result, the total debt burden is still rising. RBA, please note. Now, the latest household finance ratios from the RBA using ABS data show that total household debt to income to September 2018 fell from 189 to 188.6, whilst the housing debt to income rose from 139.4 to 139.6, and the owner-occupied ratio rose from 107.4 to 108.4. Now, this ratio includes households and unincorporated businesses, small businesses essentially. So we see the continued consolidation of debt around housing, while other forms of debt, such as credit cards, diminished. In fact, the change quarter on quarter for owner-occupied housing debt is close to 1%. So have no doubt, debt relative to income for housing is indeed still rising. The asset to income data in the same series fell thanks to the fall in value of housing. And the ratio of household assets to income fell from 956 to 950.8, and the ratio of housing assets to income fell from 517.3 to 508.4, down 1.7% in the quarter and 2.7% for the year to date, while the ratio of financial assets, like stocks for example, lifted from 410.3 to 404.5, though it'll be lower now thanks to the recent market falls. Now, in other words, whilst the debt is growing, the value of the housing assets are falling. Now, that's a double whammy. And the final dimension is interest payments, both of which are higher thanks to bigger loans and only small changes in mortgage rates and little change to income. The ratio of housing debt interest repayments to income rose from 7.4 to 7.5%, and interest payments on all debt rose from 9 to 9.1%. This is confirming the growth trend since 2016, where the out-of-cycle interest repayments hit. Now, the point to note here is that the 1/3 of households with mortgage debt are seeing a rise in the share of income going to support the interest repayments at these extremely low emergency interest rates. And that is the point. The averages mask the marginal borrower who remains under extreme pressure, which is why mortgage stress continues to rise. And we're going to report on the December data in a week or so. So the key takeaway as we move into 2019 is that the debt machine is still working. More households are being encouraged to get deeper into debt, despite the clear evidence of massive overborrowing. A strategy applauded by the RBA, the Treasury, and the banks. Now, we think we need a change in strategy because debt-fueled household consumption and property speculation will be one of the nails in the economy's coffin down the track. Interest rates will rise. The other is sporty corporate borrowing, but that is a story for another day. Finally, season's greetings to all of our followers and our best wishes for a debt-free 2019. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.